Good morning, Facebook. Jerry Hattershite, 1 Minute Mortgage Pro. Wanted to do a quick video on student loans. I actually got a message last night asking about student loans and kind of how those impact eligibility when it comes to getting qualified for a home loan. So a couple dynamics to that. One, if your student loans are not current, they have to be brought current before you be eligible. So they can't be behind. Secondly, if they go far enough behind, the government will buy those back. See, most student loans, not all of them, but most student loans are actually backed by the government. So if it goes far enough behind, the government's going to buy those back and basically pay off the bank that loaned you the money. Now you owe the government. The government will basically, for all intents and purposes, tattoo your credit, and you'll never be able to get a government loan of any kind until those are paid off. And that includes almost every type of mortgage. And from my understanding, every type of mortgage is moving that direction. So very soon, it'll probably be every kind of mortgage. So make sure the student loans are paid up, at least current. And if they're behind far enough, they went back to the government, make sure you get those caught up, paid off. A lot of loan programs and a lot of lenders will allow you to have a payment program to get those caught back up, and they'll overlook the fact that they were behind sometimes. So just kind of a heads up on that. They do affect your credit score as well. So if you got late payments, it obviously is going to impact your credit score, which can directly impact your eligibility. And then lastly is your debt to income ratio. If you're not familiar with that, I'll be doing a video on that later. But basically, it's factoring your debt and your income and seeing how much you're eligible for on a monthly payment basis. How large of a mortgage payment can you have? And so when we factor in more debt, which would be your student loans, it impacts your debt to income ratio and how much you can actually get a loan for. So look at it from this standpoint. 1% roughly is what we have to factor in at this point. Now those rules are always changing, but right now that is what the rules are. So if you got a $100,000 loan, we have to factor in a $1,000 payment, or whatever your payment is if your payment is larger. If your payment's deferred or in forbearance, doesn't matter. Does not matter. It has to be 1% or your mortgage or your monthly payment, whichever is more.